Last year, Costco sold $270 billion of goods. After paying for those goods, and after paying for every warehouse, every employee, and every truck, what the selling left behind was about $5 billion, under 2 cents on the dollar. In the same year, it collected $5.3 billion in membership fees. That number is larger. So a company that most people think of as a very good shop made more from selling the right to shop there than from the shopping itself. And the reason that is true is not a trick, not a loophole, and not hidden. It is printed in a document the company files with the federal government every autumn, and its executives discuss it out loud. This episode reads that document. Ask why the prices are low, and almost everyone gives the same answer: volume. They buy enormous quantities, so they get better prices, so they charge less. That answer is true, and it is not the mechanism. Every large retailer buys in enormous quantities. Volume buying is the price of entry to the industry, not a strategy that separates one company from another. If volume alone produced these prices, the largest retailers in the country would all price like this, and they do not. Something else is going on, and it shows up as a single number in the annual filing. Take the $269.9 billion of goods sold last year and subtract what the company paid for those goods. $239.9 billion. The difference is $30 billion. Expressed as a share of sales, that is 11.1%. That is the gross margin. It is the entire space between what a thing costs the company and what you paid for it, and everything the company does has to fit inside it. Turn it around, and it is easier to feel. For every $100 of goods on the shelf, the company paid a little under 89 and asked you for 100. The average markup over cost is about 12.5%. There is no version of ordinary retailing that runs on 12.5%. 11 cents on the dollar sounds thin already. It is thinner than it sounds, because that 11 cents is not profit. It is the pool from which everything else is paid. The lights in a building the size of a city block, the refrigeration, the staff, at wages the company is publicly proud of, the forklifts, the receiving docks, the parking lot, the accounting department, the software, the head office. All of that appears in the filing as one line: selling, general and administrative expenses. And last year, it came to $25 billion. As a share of sales, 9.25%. So 11.12 cents comes in on every dollar of goods, and 9.25 cents goes straight back out to run the operation. Subtract one from the other, and you have the answer to what selling $270 billion of merchandise actually earned. 1.87 cents on the dollar, about $5.1 billion. That is the entire contribution of the retail operation. Every negotiation with a supplier, every pallet moved, every hour worked, all of it, and what falls out the far end is under 2 cents for every dollar that went through the till. Which raises an obvious question. A company earning under 2% on its main activity is a company living very close to the line. So how is this one comfortable? Go back to the top of the income statement, and there is a second revenue line sitting above everything we have discussed. Membership fees, $5.32 billion. That line has almost no cost underneath it. The warehouses were already built, the staff already hired, the software already written, all of it paid for out of the merchandise side. The fee arrives on top. Add the $5.32 billion of fees to the $5.06 billion the goods produced, and you get $10.38 billion, which is exactly the operating income the company reported. The two numbers are almost the same size. The fees are slightly larger. This is the point where the shape of the thing changes. If you had never heard of this company and someone showed you only those two lines, you would not describe it as a retailer that happens to charge a subscription. You would describe it as a subscription business that runs an enormous shop in order to make the subscription worth having. The shop is not the product. Access to the shop is the product. And the shop is deliberately operated at close to break-even so that access to it is worth paying for. That is why the prices are low, not because volume makes them low, though volume helps. Because low prices are the thing the membership buys, and a membership nobody renews is a business with no profit at all. Two things this episode is careful not to say, because the arithmetic invites both of them and neither is supported. The first is that the company sells at cost. It does not. 11.1% is a real margin on $270 billion of goods, and $30 billion is a very large amount of money. The second is bigger. It would be easy to say the merchandise operation makes nothing and the fees are the only profit. That is not what the filing shows, and the difference matters. The company does not report these as two separate businesses. It does not divide the cost of running a warehouse between the selling of goods and the value of the membership, because those two things happen in the same building at the same time. Charging the entire $25 billion of operating expense to the merchandise side is a choice I made in order to explain the structure, not a line item anyone reports. What is exactly true is narrower and still remarkable. Remove the membership line from the statement as filed, and operating income falls from $10.38 billion to $5.06. It does not tell you what the business would look like if it had never sold memberships, because it would not be this business. Here is the part that surprised me, and it is the reason this episode is not the story you may have heard before. The idea that membership fees are the whole profit has been repeated for years. It was closer to true once, and it is getting less true every year. 3 years of the same two lines. In the year ending 2023, the merchandise operation contributed $3.5 billion, and fees contributed $4.6. Fees were 56% of operating income. The next year, 4.5 against 4.8, 52%. Last year, 5.1 against 5.3, 51%. The merchandise contribution grew by about 43% over those 3 years. The fees grew by about 16%. So the part everyone describes as the whole business is quietly becoming a smaller share of it, and the part everyone dismisses is growing faster. The filing shows where that came from. Gross margin as a share of sales went from 10.57% to 10.92% to 11.12%. 2/3 of a percentage point in 3 years. On sales of this size, 2/3 of a point is nearly $2 billion a year. The company attributes part of last year's improvement to fresh food and to its co-branded credit card program, and part of the movement to its own label. Its own brand generally carries higher margins than the national brands it sits beside, and it is a growing share of what the company sells. None of which is dramatic. That is rather the point. 2/3 of a percentage point, accumulated quietly, moved more money than most companies earn. Before that trend gets treated as a law, one correction from the filing itself. The oldest of those 3 years was 53 weeks long rather than 52. Retail years do not divide evenly into weeks, and every few years one of them gets an extra one. An extra week of trading flatters the oldest year's sales and costs, which makes the 3-year growth in the merchandise contribution look slightly larger than it is. The direction is not in doubt. Gross margin percentage rose in each of the 3 years, and a percentage is not affected by the extra week. But anyone quoting 43% growth should know there is a week of noise inside it, and I would rather say so than let it pass. The fee itself is unremarkable, which is part of why it works. In the United States, it is $65 a year for the basic membership, whether personal or business. Members can pay a further $65 to upgrade to the higher tier. Prices differ in other countries. $65 once a year from 81 million paying members. That is the $5.3 billion. It is worth pausing on how ordinary that is. There is no complexity in it, no variable pricing, no negotiation. It is the single, simplest line in a $275 billion income statement, and it produces more than everything else the company does. And there is a detail in the membership numbers that changes how you should read the fee. 81 million people paid. But every paid membership comes with a free household card, and the company reports 64.2 million of those. Add them together, and there are 145.2 million cards in circulation. So for every 9 people carrying a card, only about 5 paid for one. The rest are somebody's household. That is not generosity, and it is not an oversight. A membership that admits 2 adults is worth more than twice as much to the household that holds it, which makes the $65 easier to justify and easier to renew. And it costs the company nothing to issue the second card because the first one already paid for the building. One more number from the same page, and it is the kind of caveat that usually gets dropped. The company states that its membership counts include memberships that expired and were not renewed in the preceding 12 months. It says the share is small and that many are later renewed. It is still not the same thing as 81 million current members, and anyone quoting the figure should know that. The higher tier is where the structure gets more interesting because it hands money back. Members on it earn 2% on qualifying purchases, generally capped at $1,250 a year, redeemable in the warehouse. 2%, against a merchandise operation that nets under 2%. The reward is larger than the margin on the goods that generated it. That only makes sense if you have stopped thinking of this as a shop. Handing back 2% to keep somebody renewing a $65 fee and coming more often while they do is not a discount. It is a retention cost, and it is paid out of the value of the membership rather than out of the sale. 38.7 million of the 81 million paying members are on that tier, and the company reports that those members account for about 73.6% of worldwide sales. If access is the product, then renewal is the only number that really matters, and it is very high. 92.3% in the United States and Canada, 89.8% worldwide. Those are 2 different numbers for 2 different areas, and they get quoted interchangeably in a way that is not quite honest. The lower one includes newer international markets and memberships sold online, which the company says renew at a slightly lower rate. Even so, roughly 9 in 10 people who paid last year paid again. For a subscription that has to be revalidated by a physical trip to a large building on the edge of town, that is an extraordinary figure, and it is the number the entire structure rests on. Every competitor can read the same filing. The structure is public, so why is it not everywhere? Because it only works in one direction, and the direction is uncomfortable. To make a membership worth $65, the prices have to be low enough that a member notices. To keep prices that low, the margin has to stay near 11%. To survive on 11%, the cost of operating has to stay near 9%, which constrains how many products you can carry, how often you can change them, how much of the store can be devoted to anything that does not turn over quickly. A conventional retailer that adopted the membership fee without accepting the constraint would collect the fee and give nothing back for it, and the renewal rate would answer within a year. The fee is not a revenue idea bolted onto a shop. It is the output of a set of restrictions the whole operation has to accept first. You can see those restrictions in the building itself, and they are usually mistaken for cost cutting. Concrete floors. Goods on pallets, still in the shipping packaging. No decoration. A narrow range in each category rather than a wide one. Bulk sizes. The layout that makes you walk past everything. None of that is austerity for its own sake. Every one of them is a way of keeping that 9.25% operating cost from rising, because if it rises, the 11% margin cannot cover it. And if the margin has to rise to compensate, then the prices rise. And if the prices rise, the membership is worth less. The unattractiveness is load-bearing. A structure this tight has specific failure modes, and the filing is candid about several of them. The company states plainly that its ability to grow the membership base, increase the share on the upper tier, and sustain high renewal rates materially influences its profitability. That is, a company telling its shareholders which number to watch. If renewal falls, the fee income falls immediately, and the merchandise operation underneath it earns under 2%. There is very little cushion between a bad renewal year and a bad year. If operating costs rise faster than margin, the same squeeze arrives from the other side. Wages, healthcare, and utilities are named in the filing as costs that are partly outside the company's control. And if the low prices ever stop being noticeably low, the fee stops being obviously worth paying, and the whole thing unwinds in the order it was built. It is worth saying what is actually rare here, because it is not the low prices. Plenty of retailers run on thin margins. What is unusual is that this one is thin on purpose and has a second, structurally separate income that lets it stay that way. Most thin margin retailers are thin because competition forced them to be, and they spend their time trying to widen it. This one has an incentive to keep the merchandise margin from widening, because a wider margin means higher prices, and higher prices make the membership harder to justify. That is a company whose profit motive points at keeping its own prices down. It is a rare alignment, and it is entirely mechanical. No goodwill is required to explain it. It also explains something that confuses people about how this company behaves. When it declines to raise a price that it obviously could raise, the usual reading is restraint, or principle, or a founder's stubbornness. Those explanations may all be true, and none of them is necessary. Raising the price collects a little more margin on one product and takes a little away from the reason 81 million people renew. The arithmetic does not require anybody to be virtuous. It just makes the obvious short-term move a bad one, which is a much more durable arrangement than good intentions. So the $65 is not an entry fee, a loyalty scheme, or a way of filtering customers, though it does all three. It is the payment that lets a shop of that size operate at close to break-even without going out of business. You are not paying for the right to enter. You are paying for the reason the prices inside are what they are. Which also explains why the answer to whether the membership is worth it cannot come from a financial statement. That depends on what you buy and how often, and no filing knows. What the filing does tell you is what the fee is doing. It is not the company's bonus. It is roughly half of its profit, and without it, the operation on $270 billion of sales would be running on 1.87 cents on the dollar. Everything in this episode came out of one document, and it is public. The company files an annual report with the Securities and Exchange Commission every autumn. The income statement is 4 lines long in the part that matters: net sales, membership fees, merchandise costs, operating expenses. Subtract the third and fourth from the first, and you have what the selling earned. Compare that to the second. It takes about a minute, and there is nothing specialized about it. Most of what is confidently said about large companies is available in this form, and almost nobody looks, which is the reason a version of this story that stopped being accurate several years ago is still repeated. So here is what you are looking at the next time a price seems too low to work. The margin on it is about 11 cents on the dollar, and 9 of those go to running the building it is standing in. What is left over from selling $270 billion of goods is under 2 cents on the dollar, and roughly half of this company's profit does not come from the goods at all. It comes from 81 million people paying $65 for permission to be in the room. The price is not low despite the business model. The price is the business model, and the fee is what pays for it. And it renews in about 9 cases out of 10.